The ongoing conflict with Iran is often framed as a distant geopolitical struggle, but from an America First perspective, it is something far more immediate and consequential, a direct test of U.S. economic strength, fiscal discipline, and strategic priorities. What appears on the surface to be a regional war has, in reality, exposed underlying vulnerabilities in the global financial system that disproportionately affect the United States, particularly the long-standing dominance of the U.S. dollar. For decades, the dollar has functioned not just as a currency, but as the backbone of American global power, enabling the U.S. to finance deficits, project influence, and sustain a high standard of living. However, the current conflict is revealing cracks in that foundation, raising serious questions about whether U.S. policymakers are overextending the nation abroad at the expense of long-term domestic stability. At the onset of the conflict, the dollar behaved exactly as expected. In times of global uncertainty, investors traditionally flee to safety, and that safety has historically meant U.S. Treasuries and the dollar. In March 2026, the U.S. dollar index, DXY, rose nearly 2% as markets entered a risk-off mode, with capital flowing into American assets. This surge was reinforced by a spike in oil prices, which crossed the critical $100 per barrel threshold due to disruptions in the Strait of Hormuz. Because oil is primarily priced in dollars, higher prices forced energy-importing nations to secure more dollars, temporarily boosting demand. On the surface, this looked like a reaffirmation of dollar dominance and American financial leadership. But this initial strength was misleading. By April 2026, the narrative began to shift. Markets started to look beyond short-term panic and focus on deeper structural issues, slowing global growth, disrupted supply chains, and the possibility of prolonged instability. As these concerns mounted, volatility increased in key dollar benchmarks like the Bloomberg Dollar Spot Index, signaling that confidence in the dollar was no longer absolute. From an America First standpoint, this shift matters because it suggests that U.S. economic resilience is being questioned, not just by adversaries but by allies and investors who have long depended on the stability of the American system. One of the most critical issues exposed by the conflict is the strain on the petrodollar system. Since the 1970s, the United States has maintained agreements with major oil-producing nations to price oil in dollars, ensuring a constant global demand for its currency. This system has been a cornerstone of U.S. economic power, effectively allowing America to run large deficits without the same consequences faced by other nations. However, the conflict with Iran has disrupted the physical and financial infrastructure that supports this system. The Strait of Hormuz, through which roughly 20 million barrels of oil flow daily, has become a choke point subject to intermittent closures and threats. This disruption not only affects energy markets, but also weakens the mechanisms through which petrodollars are recycled back into the global financial system. More concerning is the emergence of alternatives. Countries like China are increasingly promoting the use of the yuan in energy transactions, a development often referred to as the rise of the petro-yuan. While still limited in scale, these efforts represent a strategic challenge to the dollar's dominance. Even small shifts in how oil is priced and traded can have outsized long-term effects, especially if they signal a broader willingness among nations to move away from dollar dependency. For the United States, this is not just a financial issue, but a strategic one. The erosion of the petrodollar system would reduce America's ability to finance its government and project power globally without immediate economic consequences. Compounding this problem is a growing sense of uncertainty among key U.S. partners in the Gulf. Countries like Saudi Arabia and the United Arab Emirates have historically aligned with the United States, not just for economic reasons, but for security guarantees. These guarantees have underpinned their participation in the dollar-based oil system. However, repeated attacks on regional infrastructure, escalating missile threats, and perceptions of inconsistent U.S. commitments are causing these nations to reconsider their position. From an America First perspective, this raises a critical question. Is the United States overcommitting resources to protect global interests while failing to secure clear, reciprocal benefits? As these allies explore diversification strategies, both in security partnerships and financial reserves, the implications for the dollar become even more significant. A gradual shift away from dollar-denominated assets by major oil producers would weaken one of the key pillars supporting U.S. financial dominance, This is not a hypothetical risk, but a slow-moving trend that could accelerate if current conditions persist. At the same time, the conflict is placing enormous strain on the U.S. fiscal position. With national debt already exceeding $38 trillion, the additional cost of war, estimated at nearly $1 billion per day, is pushing the limits of sustainability. This figure does not even account for indirect costs such as higher energy prices, increased defense spending, and economic disruptions. From an America First standpoint, this raises serious concerns about priorities. Every dollar spent on prolonged foreign conflict is a dollar not invested in domestic infrastructure, economic growth, or debt reduction. The broader economic impact is also troubling. Rising energy prices and supply chain disruptions are contributing to inflationary pressures reminiscent of the 1970s, a period marked by stagflation, high inflation, combined with stagnant growth. This creates a difficult environment for policymakers, particularly the Federal Reserve. On one hand, the Fed must control inflation to protect purchasing power. On the other, it must ensure that the government can continue to finance its debt without triggering a financial crisis. This balancing act becomes increasingly precarious as debt levels rise and economic growth slows. In such a scenario, the Fed may be forced into policies that prioritize short-term stability over long-term strength, such as keeping interest rates artificially low or expanding its balance sheet through increased purchases of government debt. While these measures can provide temporary relief, they also risk undermining confidence in the dollar by increasing the money supply without corresponding economic output. Over time, this can lead to currency depreciation and further erosion of global trust. Simultaneously, the geopolitical landscape is shifting in ways that challenge U.S. financial dominance. Countries around the world, particularly within the BRICS bloc, are accelerating efforts to reduce their reliance on the dollar. This includes developing alternative payment systems, conducting bilateral trade in local currencies, and even exploring the creation of shared reserve assets. These initiatives are driven not only by economic considerations but also by a desire to avoid exposure to U.S. sanctions and financial pressure. From an America First perspective, this trend highlights a key unintended consequence of U.S. policy. The more the dollar is used as a tool of coercion, the more incentive other nations have to find alternatives. While sanctions can be effective in the short term, their overuse may ultimately weaken the very system that makes them possible. Another emerging concern is the declining appetite for U.S. treasuries among foreign investors. Historically, treasuries have been considered one of the safest and most liquid assets in the world, forming a critical pillar of global finance. However, growing concerns about U.S. debt levels, political polarization, and foreign policy decisions are leading some investors to reduce their exposure. This shift could force the United States to rely more heavily on domestic buyers or central bank intervention to finance its deficits. Such a dynamic creates a dangerous feedback loop. Reduced foreign demand leads to higher yields, which increases borrowing costs, further straining the fiscal position and putting additional pressure on the dollar. Over time, this could contribute to a gradual erosion of the dollar's dominance, not a sudden collapse, but a steady decline in its relative importance. For the United States, the implications of this shift are profound. A world in which the dollar is no longer the uncontested global reserve currency would be one in which America faces greater constraints on its economic and strategic choices. Persistent deficits would become harder to sustain, sanctions would become less effective, and financial markets would likely become more volatile. From an America First standpoint, the lesson is clear. Maintaining dollar dominance requires not just military strength, but economic discipline, strategic clarity, and a focus on domestic resilience. The current conflict with Iran underscores the risks of overextension and the importance of aligning foreign policy with national economic interests. Ultimately, what is unfolding is not just a regional conflict, but a pivotal moment in the evolution of the global economic order. The intersection of war, energy, and finance is reshaping the rules that have governed international markets for decades. For the United States, the challenge is to navigate this transition in a way that preserves its core strengths while avoiding the pitfalls of overreach. The era of unquestioned dollar supremacy may not end overnight, but the direction of change is becoming increasingly clear. The question is whether the United States will adapt its strategy to protect its long-term interests, or continue down a path that risks undermining the very foundations of its power.